Good day, everyone. My name is Simon Putt, and I have the pleasure of being joined by my colleagues Craig Murrin and Chris Williams.
Afternoon.
Together. Good afternoon. Together, we are financial advisors with GWM USA. We are working out of GWM's West Coast office with the prime responsibility of guiding financial planning for residents of the United States of America. And what we are doing now is working on a series of videos and podcasts where we just simply share some of our views and thoughts about aspects of financial planning. So what we want to do in this particular video is nice and short and simple and sweet, is cover off what we consider to be 10 fundamentals of financial planning. We'll go through each of these, and you may well think, well, there's more depth for each of these topics that we're going to cover, and we will do that in future videos. But for now, it's just going through these on quite a high level view. I think one point that we'll make at the outset is that this is not an exhaustive list, and some of these points might be more relevant for some people more than others. But, you know, as a central set of rules, we think this is pretty solid in terms of having a solid foundation for financial planning. So, gentlemen, if you're happy, I'll kick off with what we consider to be paramount, number one, shall we say, which is very simply to clear any bad debts away. It's worth making a differentiation between good debt and bad debt. By good debt, we would consider debts like a mortgage or a car loan, where there's security and the cost of the loan is invariably very cheap, versus bad debt, which would be principally your credit card debt or personal loans, which are clearly burdensome, onerous, expensive. And really the biggest problem with that is simply compromising and paralyzing your ability to grow your finances. If it's a struggle simply to pay the interest, let alone pay down the principal, then you're hamstringing yourself against future growth. So before we consider anything else in financial planning, we would say clear your expensive debts away.
Yeah, totally agree with that. And there's a lot of additional, not just necessarily credit cards, because those interest rates are horrendously high most of the time, but certain individual products. I actually personally have a rather high interest vacuum cleaner, which was incredibly expensive. It's a Rainbow. I'm not going to tell people how much it costs, because if you know it's a Rainbow, then you'll know how much. It's very, very good, but the interest rate on the financing of that was horrendous. So any hire purchase finance agreements, I would throw into that, as well as bad debt. Get that out. But I agree with you. Number one, get rid of that.
Yeah. And it's a hard thing to sometimes to say as well, isn't it? I often think debt's so easy to get into and so hard to get out of. And especially I think younger people maybe coming out of the university system or sort of starting off getting their first home, you're encouraged in some respects to take on so much debt. And if I think it's something, even I was speaking to maybe a younger person that probably wasn't ready to start saving for the future, that would always be my first bit of advice, is just avoid debt at any cost you can. It's easy to preach, and obviously everyone's got their own situation. It's not from a place of judgment, it's from a place of understanding the damage that can do if you're not careful.
Yeah. It's tough though when you want to build credit in a new country, for example. Credit cards are your friends, because you need to have credit to build credit, and that's the vicious circle. But as long as you're maintaining that mentality of paying it off, I think is, spend what you can afford, and make, on your credit cards, make sure you pay it off every month, or as the majority of it off every month, I think is definitely the way forward.
So sorry, Simon. Yeah, just definitely discipline on that score, to know how much you're paying back, to earmark that amount first from your surplus. Yeah. And to sort of, I think if you can always keep yourself structured and organized, then you're generally okay. I think it's when it starts to get a bit out of control and you're not quite sure what's where, is when it all starts to get troublesome.
It certainly can be daunting. And, one of the things that we'll consider in a future video are strategies that can work to help you climb that mountain in terms of clearing that. But that's something, as I say, we'll look at in more depth in a future video. Let's move it on. Craig, would you want to pick up the second point?
Yeah, I would say that having around minimum of 3 months worth of cash in your bank for just your living expenses. So how much do you spend every month? Not necessarily going out, but how much do you need to have for bills and things like that? So have 3 to 5 months worth of living expenses in your bank account in cash as a buffer. So if God forbid something was to happen and your income stopped or whatever, you have got 3 to 5 months worth of money that you can live with, and then you're not sort of stressing immediately, when COVID hits and everything shuts down. You've got that little bit of buffer, so you can survive for a few months. That I think is certainly up there with one or two to have.
There's an important subtext there, Craig, in terms of, you're completely right, having that 3 to 6 months of cash in the bank. I think the important subtext is actually knowing what your monthly cash flow is. And I think there are a lot of people out there who just don't know what they spend monthly. So it's a great discipline, a great exercise to actually do that, possibly with an advisor to help you build the spreadsheet and see actually what your monthly budget looks like. And then it gives you so much certainty in terms of what the right level of cash is in your bank account.
It's vital. Having a budget saved me.
I feel for good times, people may think, I don't need the cash buffer as much. Like, things are good, job's going well. I really do need that new pair of shoes. You know what? I probably don't need that cash buffer. 2020 teaches one thing, is that you can't always predict what's going to happen next. So I used to say 3 months of a cash buffer when I initially sort of speak to some clients. I might now up that.
Yeah.
I might encourage actually more 5-6 months, depending on their situation, because life is so much more unpredictable than we think it is, and we're often, when it seems it's most simple, is when it can obviously get things most complicated.
Yeah, no, I agree with that. It's everyone is unique, so everyone is different. It's not everybody will work out what they think they want, but having that cash buffer is key, I think, in financial planning.
I think there's been no more evident than today, where people have lost work or have had salary cuts. So having that emergency reserve is clearly so important. Yeah. Chris, you began to touch on something there, which I think really then takes us into the third point that we want to cover, which is on the area of savings.
Correct. So I used the word discipline, which, after paying off credit cards, well, if you are in an okay position and you do now have a bit of a surplus income, what does that mean? Something I'd always encourage people to think about is putting a set amount aside each month, irrelevant to what else they're doing, to kind of build that buffer for the future. Be that, if you are looking to take out an insurance policy or something, or if you are just building cash month after month after month, because a little bit now does go a long, long way. And it's that, I think we touched upon it last week, about delaying gratification. And of course, you always want to spend the money you have, and there's always something you need to purchase. But by having that discipline now, when you're 55, 60, you'll be really glad you did. Yeah,
I agree. Just doing something, whether it's $5 a week, not everybody can afford to save thousands or hundreds. But just doing something, having that discipline, having that set up in place, whether it's $5, $10, $20, over the course of 2, 3, 5 years, that will turn into money. And as you grow as an individual, you'll start to earn more money and you can save more. But get into the routine, I think, of just saving something, and put this in a pot. This isn't savings for accessibility. It's just having money saved for the future, for whatever it might be, rainy day, whatever it is. But have that separate from your cash savings. Have that somewhere, maybe in an interest earning account, although these days you're not going to find much interest, but have it somewhere you can't really touch it so quickly, I think, is something important with that.
I mean, I reference sort of later stages of life only because the compounding effect has the greatest potential when you start young. There isn't to say there isn't any point in life when you can benefit from saving a little bit. It really is just that mindset.
Yeah.
Like I keep coming back to it. It's in a sense paying your future self. I've always sort of seen it in a way, encouraging, helping yourself out along the road.
For sure.
I think the only thing I'd just add, I mean, they're all absolutely right points, is don't procrastinate. It's, even if people think, I'm not going to be retiring for another 30 or 40 years, the more you can do as soon as you can, the more you'll reap the benefits in the future. There's a bit of a cliche in our industry to talk about time in the markets rather than trying to time the markets. And it's so right. Yeah, the longer you can be doing this, even if it's for small amounts to begin with, whatever you can save, and you'll appreciate that you did that when the time eventually comes.
100%. Just to finish on that, there's a couple of apps here in America, Stash, Acorns. or Acorn, I think the app is, that will take your pennies and round up
Yes.
to sort of round numbers on when you're buying things, and that will just save it for you. Those things are huge. You know, if you don't have lots of surplus income, then saving $1 or $2 every time you go to the supermarket, after a year, you look back at how much that could potentially be. You could have a few $100s saved there. You keep doing that, and the compound interest that Chris mentioned will take effect. And before you know it, you'll have a substantial amount of money there that could pay for kids' education, holiday, whatever it might be you want to use it for. But definitely doing it is the first thing, is just do it. Whatever amount, do it.
The term is time value, and I'm keen that we don't always talk about this on every point, the time value of money and compound interest. And I will talk about that in its own, probably the same podcast a little bit later on. But I feel like we keep coming back to this because we know how important and powerful it is once you've understood it. And I suppose that's in so many respects of helping our clients understand the huge potential they have in front of them just by allowing time to pass.
For sure.
Okay, well, let's move it on. This is all good stuff so far, but let's move it on to another equally important topic, which is our number 4, which is protection. You know, we talk about wealth, we talk about growth of money, but, you know, if something bad happens out of the blue, all of that wealth could instantly be blown away in an instant. So, you know, by protection, we're principally talking about insurance. And I think in the same breath, it's important to understand that different people have different insurance needs. And so, you know, it's important to really understand what it is you need to be protecting. So, for example, if you have a family and you're the breadwinner in the family, you know, you would be looking to protect that family against your passing away and leaving your family financially destitute. If you are in a position of leaving behind large debts, well, once again, you probably want to have some insurance in place to protect against those. And I think a broad topic is in the area of critical illness cover, or, you know, something that could be covered by living benefits. You know, we're all vulnerable, no matter how healthy we might think we are today. Anything can happen out of the blue, none the more evidenced than by what's happening in this day and age. So having something that protects us, you know, and that would protect our income against, you know, a temporary period of lack of work and income is clearly hugely important. So yeah, protection of your assets, protection of your family are vital financial planning aspects.
I would add on that as something recently I found out here, trust planning and estate planning in America. Certain states have got lower death taxes or death allowances, I think, than other states. So if you've got high net worth individuals in certain places like Boston, Massachusetts, they've got quite a low threshold. So if you've got an asset value investments within yourself of maybe $5 million, then you need to be making sure that you've got a trust in place or something like that, so that you can ensure that you don't lose it all on death, because it's a lot higher over there than it is, say, here in Nevada. So there's certain aspects of planning the estate specific for here that it's very, very much vital that you do speak to somebody that knows what they're talking about, so you put that in place.
And speaking for the UK, and I'm sure the US, getting that bit right is so crucial, because nothing destroys wealth quicker than tax, and especially death taxes like that. I certainly think that's when our value comes in tenfold. Yeah,
I think this really nicely rolls into the next point, is making sure that you are planning for your future. What are your goals? What do you want to get out of life? What do you want to leave your family and your loved ones? So making sure that you've got that plan in place. And it may not be a comfortable conversation. Nobody likes to think about death. No one likes to think about what's going to happen, you know, what if the worst happens and things like that. But having a plan and discussing it with your partner and identifying those long-term goals and making sure that you're on that path, making sure that if it's an investment goal or if it's whatever goal it might be, just making sure that you've got a plan and that you're taking it. You may fall off of that path a lot. That's fine. You know, life isn't a straight line. I'm sure everybody's seen that the slide that is A to B, what we want life to be, and then what life really is, and it's just a squiggle of lines, and then you get there. So we know life isn't always going to be easy, but having a plan that you can try and stick to will at least give you, I think, a little bit of guidance when you are walking through your financial life.
And the thing is, we can make those plans and those goals quite tangible. I mean, for example, retirement may seem very distant for some people, and it's very difficult to quantify what that requirement looks like. And similarly, someone with very young children, for whom university requirements might not be for another 16 or 17 years, once again, the amount required looks very hard to quantify. That can all be done. It's straightforward. Inflation can be built into the model to see actually what it does look like and what your needs are. And therefore, it then becomes very straightforward to figure out how to actually directly address that goal and that requirement.
And it feels very achievable when you have that plan laid out. I think sometimes to see it in black and white and see the numbers laid out like that makes it tangible, makes it seem almost trivial in a way, getting there. It shouldn't be this hard. It shouldn't be hard.
I agree.
You just have that plan.
And it doesn't necessarily have to be a 20-year goal. It can be a 3-year goal, a 5-year goal, a 1-year goal. I recently tried to get better at golf and recently watched a video, and the guy said, don't try and aim for the pin, try and aim for something a bit closer that you can see. So in front of you, maybe 2 meters in front of you, hit the ball in line with that, and then it will then continue on to the longer distance. So maybe set a 1-year goal or a 3-year goal that is in line with your longer term goals. But just having something in place so that you've got something to follow that if you then do fall off, you can get back onto. The same with the budget that we said earlier. It's just having something in place that can guide you through the process.
Yeah. I think at the end of the day, having that plan forces action and avoids what we talked about earlier, of procrastination, because, when retirement comes or university comes, that money won't be there by magic. So, you have to take the first steps, the very fundamentals, to put yourself in the right situation.
Yeah, they say action breeds clarity. Is that the phrase people say? Action breeds clarity. And
well, it's a good phrase. Yeah.
It's now.
Like it.
Now. And it's just that's that first step forward. That is so. It's always the hardest thing, isn't it, when you first start something? The first step is the longest stride.
Yeah, we'll do anything for 2 weeks and it becomes a routine, right, or something.
Yeah. You sounded very Lao Tzu there, Chris, which was the march of 1,000 miles begins with one step.
Thank you. It may have just a meme I saw on Facebook, but I'll take the credit.
Yeah.
I love it. Okay. Well then, Chris, what would you say is the next one that we put out there?
Yeah, something to address as well. Tax. So a tangible thing.
Yes. 2
things in life are inevitable: death and taxes. It's a cliche that we hear all the time, and it kind of makes you roll your eyes, but it is so important. Not debating whether or not tax is fair or what have you, but managing the liability of tax. I personally think is probably one of our, if not our biggest value adds. When we sit down, we spoke a little bit about inheritance tax and why it exists and ways to mitigate it. In the UK, you have an ISA, which is a fantastic tax efficient instrument. They can mitigate, your income tax and capital gains liabilities as well. Obviously, you have tax products built into pensions as well. Is that something you've been thinking about? In the US, you have your IRAs and 401ks and all that. So many options open. The key importance is understanding it. Mm-hmm. And I sort of think this is why the process of sitting down with a client and going through every step is so important. Because there's so much information to quickly throw at someone.
Yeah.
And tax is such a big issue in itself. I don't know if it gets enough attention, actually.
Yeah. I continually tell people they need to speak to a CPA or a tax person to understand. We're here to go into too much detail about it, but there are so many professionals that can help, that are cross-border or whatever country you're going to be in, that can help you understand what potential liabilities you have. Another thing to take into account if you are a US resident is that we all have to file our own taxes every year, whether you're an employed person or a self-employed person or a business owner, whatever it is, everybody files their own taxes. So I pay tax every single month on my income when my salary comes through, but at the end of the year, I still may have a tax bill because for whatever reason, not enough taxes may have been taken out. So I would say within that kind of category is to make sure that you've got some sort of allowance for a potential tax bill at the end of the year, whether you're an employed person or not. I think having that buffer is key, and making sure that you are paying taxes or employing an accountant enough money, employing an accountant to mitigate those taxes and work for you and try and reduce that potential tax bill, but making sure you're aware that there is going to be a potential liability for taxes at some point.
Yeah, I think we all get it that the taxes are there, but I think the important thing is just not to take them for granted or just take them lying down. As you say, Craig, engaging someone and then taking proactive steps can certainly improve the outlook for yourself and for those that you leave behind.
And
it can make a real numerical difference when you look at the end of the year. And if you've got a tax optimized strategy and you've done it right, when you look at that balance sheet, you will have a considerable amount more money.
Yeah.
And when you do that year on year, by after 20 years, if you've made it tax efficient the whole way, you'll have a considerable amount more money.
Yeah.
And are these strategies well known enough? Do the governments do enough to let people know that these things exist to help them mitigate tax? Maybe, maybe not. That's always a conversation I'll be having very early on.
Yeah. And if anyone listening to this does have issues and wants to talk to someone about taxes, you can reach out and we can certainly connect you or give you some a list of a few companies that we have worked with in the past that can certainly help accountants, CPAs, things like that.
Yeah, okay. Let's move on to another theme. I want to pick up our seventh topic, which is simply making your money work for you. Now, we talked at the outset or early on about having 3 to 6 months money in the bank, which is great if you've achieved that. What we don't like to see, or certainly what we advise people against, is having surplus amounts of cash beyond that in the bank. So, instantly one needs to start thinking about strategies to make that excess money work more efficiently. And to that end, different strategies can be brought into play depending on your attitudes to risk, depending on what your objectives are. For example, do you want money working for you in such a way that it's going to be paying you an income? Or do you want money working for you in such a way that it's just building growth for the long term? Or a combination of the both. There are different ways to be smart with your money, take advantage of whatever interest is out there or whatever growth scenarios that are out there, and get that surplus money doing something smart for you and building greater efficiency into your cash. I think one important point that comes with this, we all know about inflation. Inflation is a cost of money that's doing nothing. This is where we talk about then having strategies that allow people to exceed rates beyond the rate of inflation.
Yes, yeah, definitely. You want to make sure that your money isn't shrinking every year. And although inflation right now is incredibly low, we are expecting to see it go up a little bit. So yeah, making sure that your money is not just sitting there shrinking every year. Cash under the bed, under the pillow was always a thing back in the day. Ask people what they're doing with the money. So it's in a shoebox. It's nice and safe. Well, yeah. The shoebox isn't doing much, so yeah, making sure.
I do love that phrase, making your money work for you. Yeah, I kind of like the connotation of taking control.
Yeah, and there's so many things out there. There's so many options out there. It doesn't have to be risky. A lot of people kind of think, investing, and I'm not a risky person, so I don't like to invest. There's lots and lots of options out there for people that are low risk investors, just to try and get better than inflation, and that's all you want to be trying to get. If you're a low risk, better than inflation. So I think that's quite important for sure.
And at the same time, there are people who do want to try and blow the roof off the house, and in which case then a kind of risk return strategy can be considered for them. So there's no one size fits all approach to this. Once again, it involves having a discussion to find out what you've got to play with, and then what's going to be the right tailored approach for you and your money to achieve the right benefits. Yeah.
Now, I would, a lot of things over here are companies, lots of bigger companies will give you lots of benefits. So they'll give you some 401ks and they will offer to match any contributions you make. And I think not enough people take advantage of that when their companies offer it. If the company's offering to match, say, 4% and you're throwing in whatever amount it is, that's extra money, that's free money, and anything you're paying over into your 401k can be before it's taxed as well, so that you then reduce the amount you're receiving, and in turn, I think then some reduce potential tax liabilities as well. But there's so many tax efficient ways by maximizing company benefits that you're getting. So speak to your HR within your job and just ask them, what do you offer me for any 401k matching payments so that you can utilize that and really increase what you're saving through the company. And it all happens before you receive it. So, if you take out $100 a month from your salary that the company puts into your 401k and they match it 4 or 5%, that is going to increase a lot bigger than you putting it in after you get paid. And also, if you put it into the 401k before you see it, then you kind of forget that it's happening, and it's happening in the background. And then in 10 years' time, you'll look back and go, oh my goodness, $10,000, $20,000, whatever amount it might be. But if you maximize these company benefits that are out there, in the majority of companies here, I think will offer retirement benefits. Same as in the UK, I think, you've got these pensions that companies are paying to, whether they're defined contribution more so now. But a lot of companies will offer incentives for you to be using it. And I think more people should be taking advantage of that.
Do you find that people are well informed on what they can do here, or is there a real sort of shortfall in knowledge in terms of what people's options are?
A lot of people don't tend to care if they're younger. So the information is there, but it's not on their radar, if you like. I think, more of my clients are certainly aware of what their benefits are, because they're 50 plus and starting to think about, when do I want to retire? Can I retire early? What are my finances looking like? And starting to increase maybe putting into their 401k. And when you do get over, I think it's 55 over here in the US, you can actually start paying more into your pension plans to basically make up any missed gaps that you had 20 years ago that you weren't paying into your 401k. So you can actually increase what you're saving, and really try and ramp that up in the last few years of work, so that when you do retire, you're kind of hitting those goals that you want to get to. But I do think people are certainly undereducated when it comes to all areas of financial planning, not just 401ks over here and employee benefits, but just financial planning in general.
It's so important. I mean, when it comes to, retirement and pension time, we could be still alive for, given life expectancies these days, 30, 40 years.
Oh my goodness, yeah.
After stopping, having a salary and an income. So whatever you can maximize while you're in this situation and ability to maximize your resources, then yeah, we've absolutely got to encourage that people do that.
And it's in everyone's interest. The government wants you to do this in many ways, because you're less of a burden on the state if you have sufficient capital when you're older. So it's designed for you. It's designed to make you get to that finish line with a sufficient amount of capital. And so I often do wonder: do we do enough to relay the benefits?
Yeah.
Is it just an easy tag on at the end?
Well, it's not. If someone doesn't have a financial professional working for them, they may not understand that. So it's more the employer's role to facilitate that education, whether it's from in getting a financial professional in to educate their staff, or whether their HR should be educating them. But I think it should start at a very young age. I think they should be teaching this in school. I think they should teach time to kids. I mean, I think it's a life lesson that people need to learn, and then too many people don't understand it, so that their kids won't understand it, and then we'll just, a mountain of kids growing up thinking that credit cards are fun.
Yeah. So that's a solid 8th point. Maximize your pension entitlements. Let's move on. I mean, Chris, do you want to pick up something for number 9?
All I had down was diversified portfolio. So, and again, there's so many different financial concepts of when you should be in one particular security or another. For me, it's always a time horizon. I would always say to someone, perhaps certainly under 35, looking at 20 years plus of saving, you want to be more in equity focused, because volatility long term means more gains for you. For someone a bit more defensive, you then look at sort of safer AAA bonds, or even gold if that's what you're looking at. For a fixed income, it's a whole different story again. What does any of that mean for you? So I, for example, will sit down with a client who previously in the past had a couple of ETFs thrown in there, had a few securities he'd bought all over the years. And we sat down, I think, in 2018, so market's still pretty good at the time. And he was approaching a point where he wanted to start living off this and drawing down an income. And we had to sort of think, well, what if there was a massive market drop? What are you going to lose so much paper wealth here? And are you in a position still to do that? That was a case of a portfolio not being diversified and us having to come in and make sure it was. And luckily it was in time for COVID. Understanding diversified portfolio is a great thing, but it all relates down to your time horizon. I'm not sure if you agree with that or disagree. By all means, disagree, but you know,
everybody is different. Everybody's portfolio should be tailored to them, whether that includes equities, whether that includes something outside of the investment market, like property or rental property, or specific businesses, you know, local businesses you might want to invest in. But just having a good grasp on what options you have, I think, is probably key to making sure your portfolio is diversified.
Understanding what diversification means for you as well. You know, depending on what stage of life you're in, making sure the assets you hold are right for you, I would say is the biggest message to relay there.
Yeah, and I think, you know, we've had this year of unprecedented volatility. Those who had positioned themselves have clearly come through the storm in a more comfortable voyage than those who weren't so diversified. I mean, this is obviously portfolio management 101, to have diversification. And I think then it extends across assets. I mean, you mentioned property, Craig. I think, you know, even having, for example, something like a little bit of gold, you know, as a sort of counter-inflationary hedge is also valuable. So once again, you don't want to put too many eggs in any particular basket, but the ability to spread your risks and spread your assets just gives longer term stability and growth opportunity.
I totally agree. And I think that literally rolls in nicely to kind of sum up with point 10.
Yes.
With diversified, is just understanding and making sure that you've got someone that's looking out for you. If it's not something you're comfortable doing, there's a lot of people that do this themselves, and fine. If that's what you enjoy doing, then great. A lot of people don't understand it and don't enjoy doing it. So having a professional, financial professional, helping you and teaching you and guiding you and kind of holding your hand through the process, I think is vital. You know, don't just stick your head in the sand and hope it will be okay because you're scared to have the conversation. Speak to somebody, ask for help, and get that guidance, and making sure that you're looking at everything regularly, making sure you're looking at your path, making sure you're looking at your goals, and keep reviewing things, you know?
Yeah, I think the important point here is that none of this is sort of one-off action. You know, you set up your savings plan, right, done, put up my protection, my insurance, great, that's done. Now, I kind of liken financial planning to looking after a bonsai tree. You know, you have to keep sort of nurturing it, trimming it, pruning it, watering it, just keep feeding it. You know, a financial planning strategy is a long-term exercise, and fundamentally, it's one that you start as soon as possible, and it's with you until the end of your days. The shape and form of that strategy would change over time, but the fact is, it's always something that needs to be managed, monitored, adjusted, and as Craig suggests, having someone alongside you who knows what they're talking about and can give you dispassionate and objective advice is a huge benefit.
Yeah.
Whatever I say is not going to be as poetic as that. Thanks, Simon. Basically, mine's a little more blunt, really. That was just the importance of getting it right. And yeah, we see a lot of the stories day in, day out, perhaps, of it all going wrong or what have you, or ill preparation. Sitting down with someone, just at the very least, talk these things through so you have a clearer idea for what your journey looks like, I would say is absolutely crucial.
Yeah.
Bonsai trees or not.
Yeah, no, I think, just keep track, monitor, review your path, review your plan regularly, and just do something. Don't hold off. If you can't afford to do something, then fair enough, that might not be your situation, but $1, $2, $5, it all adds up. Don't be embarrassed about saving $1 a week, for crying out loud. Pennies look after the pennies.
Dollars would take care of themselves. Exactly right. Yeah.
Or the dollars. Yeah.
Yeah. I think that's a neat way to sum up this discussion. We've covered 10 important points there. there may well be more. And so, we invite people's views. If you like this, then please like. If you found it helpful, then please feel free to share this with people that that you feel might benefit from this. But also let us know any comments or questions. Do you disagree with anything that we've said, or do you agree wholeheartedly with what we said? Is there anything that you want us to look into in any further detail? We're very happy to pick up on suggestions. But for now, we hope you have found this helpful. I speak for my colleagues, Craig and Chris, I'm sure I say we've enjoyed doing this. It's been a blast, and we look forward to providing you with more insights in future videos and podcasts. Now, thank you very much for your attention.
Thank you, guys.
Thank you, Simon. Thank you, Craig. Thank you.